Imagine waking up in the morning and checking your phone before getting out of bed, not out of habit, but out of quiet concern, because somewhere in the background of your mind, there is a calculation always running, a mental spreadsheet tracking the next bill, the next expense, the next unexpected cost that might appear before the next paycheck arrives. For many people, this feeling becomes so normal that it fades into the background of daily life. Yet the psychological weight it carries is enormous, and economists sometimes describe this invisible burden as a hidden financial tax, not a tax collected by a government, but a cost extracted slowly by uncertainty, instability, and constant cognitive pressure. Financial stress operates differently from most financial problems because it does not only affect numbers in a bank account, it changes the way the brain processes decisions, time, and risk. When a person lives with very little financial margin, the brain shifts into a form of short-term survival thinking, prioritizing immediate stability over long-term optimization. This shift is subtle and often misunderstood because from the outside it may look like poor decision-making. Yet behavioral economists have repeatedly observed that scarcity changes cognition itself. When mental bandwidth becomes occupied by urgent financial concerns, the capacity to plan, evaluate trade-offs, and analyze complex options quietly shrinks. One way to understand this phenomenon is through a concept sometimes called the scarcity loop. Imagine a person whose monthly income almost perfectly matches their monthly expenses. At first glance, the numbers appear balanced, but the system has no margin for error. A small car repair, a medical bill, or a temporary loss of hours at work introduces immediate instability. In response, the person must divert attention towards solving the short-term problem, often through borrowing, delaying payments, or shifting money from another necessary expense. Each solution solves the present problem while creating a new one slightly further in the future. Over time, the brain adapts to this pattern by focusing primarily on the next immediate obstacle rather than the broader financial structure. This adaptation is rational in the short term because the next bill truly matters, yet the long-term consequence is a narrowing of attention. Behavioral studies have shown that when people experience scarcity, whether financial or otherwise, their cognitive resources become heavily concentrated on the scarce resource itself. In financial contexts, this means constant attention to bills, balances, due dates, and small fluctuations in cash flow. The hidden tax appears in the form of reduced decision quality and lost opportunities. Consider the difference between someone who has financial margin and someone who does not. The person with margin can evaluate options calmly. They can compare prices, delay purchases, invest time into research, or simply wait. The person without margin often cannot afford the luxury of time. When a bill is due tomorrow, the decision must be made today, sometimes within minutes. Urgency replaces analysis. Mathematically, this dynamic compounds over time. A rushed decision may lead to a slightly higher price, a small interest charge, or a minor fee. Individually, these amounts appear insignificant, yet when repeated across dozens of financial decisions each year, they accumulate into a measurable cost. Late payment fees, overdraft charges, high-interest borrowing, and emergency purchases at unfavorable prices form a pattern that economists sometimes describe as the cost of instability. There is also a second layer to this invisible tax, one that is rarely discussed in purely financial conversations. Chronic financial stress affects sleep, concentration, and emotional regulation. When the brain remains in a persistent state of low-level threat detection, cognitive energy is redirected toward monitoring risk rather than exploring opportunity. This is not a matter of discipline or intelligence. It is a predictable response of the human nervous system. Historical patterns show similar effects during economic crises. During periods of widespread instability, households often reduce long-term planning and shift toward immediate consumption or defensive behavior. The same pattern appears on the individual level when financial security becomes fragile. Planning horizons shrink. Goals that once felt achievable begin to feel distant or uncertain. Interestingly, the mathematical threshold that begins to dissolve this hidden tax is often smaller than people expect. The presence of even a modest financial buffer can interrupt the scarcity loop by extending the time available for decision-making. Instead of reacting within hours, a person may have days or weeks to evaluate a situation. That additional time expands cognitive bandwidth, allowing the brain to move from reactive thinking toward strategic thinking. This shift is not purely financial, it is psychological. When the mind perceives stability, it reallocates attention away from constant threat monitoring. Decisions become slower, more deliberate, and often more efficient. Small improvements accumulate, not because income suddenly changes, but because decision quality gradually improves. This dynamic reveals an important insight about financial systems. The structure of a person's finances often influences behavior more than raw income alone. Two individuals earning similar amounts may experience very different levels of stress depending on the margin within their financial structure. One system absorbs shocks while the other amplifies them. Understanding the hidden tax of financial stress does not guarantee immediate solutions, but it reframes the problem. Instead of viewing financial difficulty purely as a budgeting issue, it becomes visible as a systems problem involving margin, stability, and cognitive bandwidth. When the system gains even a small amount of breathing room, the mind begins to operate differently. Over long periods, this shift compounds quietly. Better decisions lead to fewer penalties, fewer emergencies, and more opportunities to plan ahead. The invisible tax begins to fade, not through sudden wealth, but through the gradual restoration of financial margin and mental clarity.